here's our quick agenda for today. First, when partnerships end. Second, the dissolution checklist. Third, settling capital deficiencies. And finally, piecemeal distribution methods.
All right, let's jump straight into section 1, when partnerships end. Establishing the true time of death for our business scenario begs a really crucial question. What actually happens to the daily operations and the underlying books when partners decide to just walk away? Because legally and financially, the term ending can mean two entirely different things in the accounting world, and mixing them up is a classic rookie mistake. So there's a critical distinction we need to make right off the bat. When we talk about the dissolution of a partnership, the business itself actually continues. Maybe a partner retires or a new one joins. The partnership is just reconstituted and the economic relationships change. But dissolving a firm, which is our main focus today, means the business ceases entirely. The doors close forever, the assets are sold off, and the liabilities are paid. It's the final curtain call. Moving right along to section 2, the dissolution checklist. Think of closing down a firm kind of like a group of roommates moving out of a shared house. Step 1, you realize or sell off all the firm's assets. You're selling the machinery, the inventory, the proverbial shared furniture. Step 2, you pay the firm's debts and settle the final bills. Listen, you absolutely cannot pay yourselves until the outside creditors are happy. And finally, step 3, you settle up the partner's capital accounts and figure out exactly who gets the leftover cash or who owes the firm money. Now, under Section 48 of the Partnership Act, there's a very strict legal hierarchy dictating who gets paid first. You don't just throw cash at whoever asks for it first, right? Outside debts to third parties always take absolute priority. Once those outside creditors are totally satisfied, then you pay back any loans or advances made by the partners. Only after that do you refund the partner's actual capital contributions. And if, by some miracle, there's a surplus left over at the end, well, that just gets distributed in their standard profit-sharing ratio. To actually execute all these steps in the books, we use a specific temporary tool called a realization account. Instead of adjusting dozens of individual asset and liability accounts one by one, we just park them all here. We transfer everything over to this central ledger, we record the cash coming in from sales, record the cash going out for liabilities, and whatever balance is left in this account at the end is your overall profit or loss on realization. Then it's ready to be distributed to the partners. Which brings us to Section 3, Settling Capital Deficiencies. Okay, so steps 1 and 2 are complete, but what happens if a partner's capital account actually goes into the negative? This introduces the concept of insolvency. That's when a partner simply cannot pay what they owe the firm from their own personal assets. Let's say partner A owes the firm $6,000, but they go completely bankrupt. That creates a massive headache for the remaining partners who now have to somehow cover that shortfall. And here is a massive gotcha for your exams, so pay attention to this one. If the firm loses money selling a piece of machinery, which is just a normal realization loss, all partners shared that loss based on their standard agreed profit-sharing ratio. But thanks to a very famous legal ruling called Garner versus Murray, an insolvency loss is treated completely differently. That $6,000 shortfall from partner A, the surviving solvent partners have to absorb it using their capital ratio, not their profit-sharing ratio. Looking at this breakdown, it really just comes down to fairness. The courts essentially decided that a standard business loss is a normal trading risk, hence using the profit-sharing ratio. But a loss caused because your specific partner went bankrupt, that's a capital loss. So if partners B and C survive, they split partner A's $6,000 debt based purely on how much capital they had tied up in the firm right before the dissolution started. But of course this is accounting, so there are absolutely exceptions to the rule. The Garner versus Murray ruling doesn't apply if there are only two partners to begin with. It also doesn't apply if the partners had the foresight to draft a very specific agreement on how to handle insolvency ahead of time. And if literally all the partners are insolvent, well, that is an auditor's absolute nightmare. At that point, we abandon realization accounts entirely, transfer those balances to a special deficiency account, and just pay out whatever pennies are left. Let's move into our final part, Section 4, Piecemeal Distribution Methods. So in textbook problems, all the assets magically sell instantly on December 31st, right? But out in the real world, cash trickles in over months, sometimes even years, in small installments. To safely pay partners along the way without messing up the math, we have two distinct paths: the maximum loss method and the highest relative capital method. Now, both of these share one core philosophy. They want to make absolutely sure no partner is overpaid early on, so they don't have to awkwardly demand that cash back later. Let's look at the maximum loss method first and see how it builds this highly conservative safety net. Every single time a chunk of cash comes in, you basically pretend it's the absolute last dollar the firm will ever see. You look at all the unsold assets sitting in the warehouse, and you assume they are now completely valueless. You calculate that massive hypothetical loss, distribute it to the partner's accounts on paper, and only then do you see who actually still has a positive balance to receive that cash installment. It is brilliantly pessimistic.
On the flip side, we have the highest relative capital method, which is much more of a step-by-step math puzzle. You take everyone's actual capital, divide it by their profit-sharing ratio, and find the lowest number to use as your baseline. Then, you calculate what everyone theoretically should have contributed based on that baseline. Subtract that hypothetical baseline from their actual capital, and boom, you've found their excess capital. And the ultimate payoff for doing all that math is actually incredibly simple. The golden rule is just this. The partner whose capital is most in excess of their required proportionate share gets to stand at the very front of the repayment line. As cash drips in, they get paid first until their excess is completely wiped out, which brings everyone back to a nice, level playing field perfectly aligned with their profit-sharing ratios.
So, as we wrap up this explainer, I want to leave you with a bit of a provocative thought. Knowing how wildly cautious the maximum loss method is versus the direct, mathematical line jumping of the highest relative capital method, if you were the partner with the largest excess capital tied up in a dissolving firm, which method would you advocate for? Think about how these seemingly dry accounting choices impact real-world strategic decisions. Thank you so much for joining me on this deep dive into firm dissolution, and I hope this playbook serves you well.